Rahul Singh, Head of Research with Standard Chartered Securities. He joins us live now. Rahul, good morning. Thank you for joining us. Rahul, in the last 24 hours, everything has broken apart. Bonds, equities, gold, oil, emerging market debt, emerging market equities. Do you think somewhere markets are getting slightly irrational in reacting to yesterday's Fed communication?
Just to step back, yes, definitely there are some pockets of value. Having said that, on a week-to-week basis or a day-to-day basis, it's very difficult to get to the bottom of which way the liquidity might swing. So therefore one needs to pick price points for various stocks which is in their radar, and then pick at those prices, and then if they go down because of any global further global issues, then buy more, rather than looking at a broad overreaction or an underreaction, so to say. So the approach I think of the investor should be the stocks which they like. They should have some valuations in mind below which or around which they will start buying, and that's what we are trying to recommend to the clients. It's not easy in these times, but that's usually what works best. I mean, 1 year down the line, that is what you would remember as being done, which is which made you money. So obviously given our current account deficit issue, as well as the dependence on global flows to bridge that, we are a bit more vulnerable, especially the way rupee has gone. But remember that rupee also is benefiting some parts of our index. In fact, we did a nice quick analysis of Sensex earnings, and what comes out is interestingly that the Sensex earnings ironically would benefit marginally, though, if let's say today we were to rebase rupee from 54.55 to say 59.60, the Sensex earnings actually go up 2%, because they're large index weights like Reliance, IT stocks, pharma, to some extent even the auto exporters, who actually gain from weak rupee. So we need to not get swayed by the broad movements, and be cognizant of some of these gainers which are going to emerge once the dust settles down, rupee stabilizes around these levels hopefully, and then life goes on.
Rahul, what's the sense when it comes to liquidity? Do you think there could be a crisis for our markets during the second half of the year? Because yesterday FII sold about 2,000 crores in equities, and the debt market has seen an outflow of close to $4 billion in the month of June.
Right. What we have to see is in the light of or in the backdrop of the great rotation which is happening from bonds to equities globally. Unfortunately, the emerging market equities are not benefiting. The developed market equities are getting inflows much more than the equity inflows in emerging markets. In fact, equity outflows have been there in the emerging markets, and I think that's a function of the external situation, whether it's trade deficit or dependence on exports of the emerging markets, and that can only take some time to correct. And it also self-balances. End of the day, if currency depreciates enough, that is going to self-balance the current account deficit with a lag, of course, but it will take care of the current account deficit. So definitely, I think in the short term, the risk is on the downside on liquidity from out of the emerging markets, and obviously India being a part of it. But it's not like, as I said, it's not a broad brush you can paint. You should not paint a broad brush, especially when there are pockets of value emerging in India, and when there are pockets of sectors or stocks which will actually benefit if rupee were to depreciate, and some of those sectors and stocks are available reasonably inexpensive.
Rahul, the other big story today is HUL open offer will start. Do you think minority shareholders are better off tendering their shares in the open offer, because Unilever is paying top dollar to acquire shares from minority shareholders?
Yes, obviously the valuations seemingly look attractive, but if you compare it with the previous open offers, from what our analysis says, it's the premium is not as high. And the feedback we are getting is that we might get very less or lukewarm kind of tendering in this process. So that's really the feedback which we've got. I think long term we continue to be positive on Hindustan Lever. So anyone with a long term view may or may not choose to tender their shares in this offer if they think the premium is not good enough. So that's really the feedback right now, that we think that the response may not be very great.
Rahul, at a time when US Fed is of the view that global growth could make a comeback, do you think it's time to revisit growth-oriented stocks and it's time to, get out of defensives? Defensives do well when there is global uncertainty. Growth stocks do well when growth at a global level is back.
Yeah, that's a billion-dollar question, because we have thought like that, I think 3-4 times in the last 2 years, and it's not played out. I think the reason it is not played out is more India-specific, that your growth sectors, whether it's industrials, capital goods, infrastructure, are really in a slumber of a capex slowdown and policy paralysis. So unless so most of the problems therefore are of our own doing, and unless we solve those problems, I don't see that changing just because the growth is because the focus is going to be on global growth. Yes, if global growth picks up, I think what we need to look at is the exporters, especially IT services names in India, which will obviously benefit from a weaker rupee, makes them more competitive, and they are leveraged to a global recovery and US recovery. So they are the obvious kind of names. Within IT services, I think the stock which we like and which we have recently added to our conviction list is OFSS, and it's a product company, and they are not leveraged to the immigration issue, and also they are most leveraged to the weak rupee in terms of the gains from that. So we need to be a little bit selective. I don't see as a broad brush growth sectors being lapped up, because each growth sector in India, especially in the infrastructure industrial space, has its own sets of issues, which frankly some of them are getting resolved, but time is running out before the election, so we might have to wait a little longer for those issues to get resolved.
Rahul, what's the case that banks would actually recover? Because we've seen stark underperformance, not just in the way the equities have moved, but also in earnings as well when it comes to the banking names.
Banks, we continue to be negative as a whole. Though we like the private sector banks, I think the valuation there are leaving little room for error, especially if the bad asset or the NPL cycle has not seen the last of it. We haven't seen the last of the bad asset cycle, and sooner or later, that will start hitting some of these banks. That could start hitting some of the private sector banks. That's number one. Number two is that the weak rupee will make some of the local balance sheets, especially the stressed balance sheets, even more stressed. So we might see another round of restructurings and so on. Our feedback from the banks and the CDR cell is that the number of restructuring, the restructuring pipeline is continuing to grow. And lastly, on credit growth, we think, at least that's my personal view, that credit growth will come off significantly. Even on the consumer side, we might see a slowdown in credit growth. So all in all, if you put all of these things together, it really doesn't add up to a very good picture over the next 6 to 12 months. So in fact, we had only one top pick, one bank from the top picks. We have removed that also, which was ICICI Bank. So we don't have any banks in our top picks, which tells you about what we are thinking right now.
Right. Rahul, conventional wisdom is IT companies will make money hand over fist because of weak rupee. But if I just look at the 5-day change in large cap IT stocks, hear me out and then I'll seek your reaction. TCS is down 3% in last 5 days. Infosys is down 0.5% in last 5 days. HCL Technologies is flat and Wipro is up 2%. Ideally, in such an environment where rupee has plunged against the dollar, these stocks should have gone gangbusters.
Yes, but what happens is that most of the rupee benefit does not flow through immediately because the contracts do get renegotiated. So most probably you would retain only the part benefit of such a sharp depreciation in rupee. Plus, the immediate earnings may not flow because they have existing hedges and so on. So these and remember that when money is going out of Indian equities, these are some of the large weighted stocks. So it's very unlikely that someone can reduce India weightage without having to sell some of these names. So there is some pressure which these guys cannot escape because they are, end of the day, they are an Indian listed equity. But I think, as I said, once the dust settles down, I think focus will come back. And within that, we like HCL Tech and OFSS. I mean, they have outperformed. I think you might see them doing well, much better than what you have seen them in the last 5 days, in the next 5 days.
Really enjoyed reading your latest strategy report, Top Avoids for 2013. Now, on that note, you are making a case that investors should not give good companies in a bad sector a skip. Give me an example. What are you trying to imply here?
Well, I think there are names like Shobha Developers or Adani Ports, which are theoretically in bad sectors, which have bad examples of, not only outlook but also corporate governance, etc. So I think these two businesses, just as an example, I think are doing very well. They are managing the environment much better. There have been steps taken to allay the investor fears. So just as an example, these are the two names which we have highlighted. And even otherwise, if you look at the last 3 years and look at the performance variance within the sector, it's been huge. Any sector which you pick up, especially in sectors which have not done well, you have still seen stocks going up versus some stocks which have gone down over a period of 2 to 3 years. Take telecom as an example. I mean, Idea has done so well. Bharti has been flat in the last 3 years, and Arcom is actually down. So you have opportunity even in sectors where the fundamentals have been shaky because of regulations or demand outlook, and you have seen some companies and stocks doing much better than others. So I think the same will continue, because on the overall market per se, it's going to be a range-bound market till we come out of the macro kind of fix which we are in. Which will take time, and then we have general elections. So it's going to be a market where you will see these kind of variances continuing.
Rahul, good having you on the show. Really appreciate you taking the time out and joining in.